So thank you everyone for joining in this evening. Yes, it was indeed a great session by respected veteran Mr. Berman, by our fellow industry veterans across public and private sector banks, Mr. Amol, Mr. Dheeraj, and Mr. Viswajit. And we like to take this baton forward actually and define, okay, first, which was already captured, right? In principally, that precisely what's the global regulatory landscape of MRM? What are the interconnectedness of regulations and models, which we have practically seen in bits and pieces in the previous discussions already? So I would tend to say most of the points which we have tried to prepare, except the solutioning side of it, it's more or less spoken. But we'll still deep dive into the part of actually how this is there and what are the challenges which the global banks where actually MRM has been implemented effective, what are the challenges that they have seen principally, and then what does SAS brings onto the table. First, as Amol already highlighted, like, I mean, SR 11.7 remains the cornerstone of MRM, right? But the world has practically seen there are other regulations from 2011 till 2024, which is, I mean, the latest one definitely being the RBI's MRM coming into play. It has really evolved because of the systemic risk that is focused and the increased exposure that brings onto the table, right? Because unlike any other financial risk, model risk should be, I would say, the regulators are trying to say is that model risk should be judged onto the same level because this is the most critical part which is helping making banks decisions, right? So first part, I mean, almost all the regulations primarily are focused on these 5 pillars. First being definitely model inventory. I mean, it's being broadly spoken of that model inventory across the bank, right? It can be risk, it can be fraud, it can be related to compliance, it can be marketing mix models, it can be valuations, it can be derivatives pricing, right? All of that are primarily into the ambit of an MRM, which, I mean, actually the global regulations have came in. The second most critical part, which I like to just highlight here, is the model risk assessment, right? Which is basically nothing but model tiering. What exactly defines the criticality of a model? Practically speaking, of what the global regulations have been, the first is the materiality, the economic consequences of a model or a wrong usage of a model that delivers on banks' numbers. Second is the sophistication of that model, principally the large number of variables that are getting used, the stability of those parameters that are being used. And last but not the least, which is the impact of these decisions, right? Principally, a combination of these 3 qualifies or defines how the model is supposed to be tiered. And that's how the model validation, the third pillar which is there, the model validation, model monitoring, defines the frequency. It's not that every model has to be monitored annually. It defines, okay, based on that risk tiering of those models, the materiality it captures, the impact on decisions which it captures, be it credit decisioning, be it any other model, if you may say, right? So what it carries. So that defines the frequency of model monitoring as well as model validation. The last 2 pillars, which is nothing but model governance and reporting, are the key cornerstones because by the nature of it, it transacts through different set of lines. I mean, different set of departments, that is what it was already called across, right? Which is risk, internal audit, business lines, analytics teams, technology, finance, etc., right? Because finance would also be involved, let's say, while you're defining an FTP-based models or you're defining any capital projection models used for ICAP part, right? So this is from a viewpoint of model governance. What regulations have tried to establish is three distinction between 3 areas, which is first is ownership, second is control, and the third part is the compliance role. So once these 3 things are established, definitely that goes on to the 5th pillar, which is nothing but model reporting, right? That what kind of models with the risk tiering are supposed to get reported back to the board or to the any other audit committee or risk management committees all across, right? So principally, that's how the global regulations that we have seen getting involved. The next, practically, I'll let my colleague Sudhanshu talk upon it.
Thanks, Pulkit. Good evening, everyone. And I'd like to thank the esteemed panelists because they have touched upon a lot of what I was about to say, and especially Amol, because if we expand on the horizon on what we have been discussing on model risk management, and especially what RBI has been saying around credit risk, and like Amol rightly pointed out, what if we remove credit from it? And what we would end up with is looking at all these cross-functional models, whether they are decision support models, whether they are valuation and pricing models, whether they are portfolio models, especially capital forecasting models, newly introduced IRRBB guidelines, or you have your investment management related guidelines. So if we remove credit risk, this is the impact we will have. We will have to monitor models across all of these different areas. And I think it's a very pertinent question. And considering the relevance of this particular question, would the banks be planning it in a more generic way, or would they modularize or silo it specifically for credit risk? Is, I think, the question that we will wait and watch how it gets answered, how the industry moves. But in terms of preparation, in terms of looking forward, I think this is where the question mark will remain, that how do we handle it across? Another point that I would like to mention here is maybe, one ring to rule them all, if I was to take a cue from the movie, is macroeconomics. If we look at one singular event that has happened in the last decade, which is COVID-19 impact, it affected all of these models. If you look at credit risk models, even if you look at liquidity models, all of these models breached, all of the performance of these models were affected, and not just for 2020. These models were impacted for a longer duration of time because we keep on referring to the same historical data. So again, we need to have that kind of adjustment happening with our models. That is where the real model risk lies. So I'll again circle back to the same what if question. How would you manage it? Would the challenges remain the same? Yes. What are those challenges? I'll pass it over to my colleague Pulkit to highlight on some of those.
So, yes, there are challenges, right? But before even going into the challenges which the global banks at least has practically faced in, one of the major challenges which could also come in is the macroeconomic indicators used in, let's say, in ECL models and the macroeconomic indicators used in IRRBB models. There could be different correlations seen, what has been seen in ECL versus what has been seen, right? Which could potentially also lead to a conclusion that why are different macroeconomic factors related to, yes, statistically proven that they might be correlated to a different default rates, and historically they can be, but that's again remains a point of contentious, right? That how are we building a term structure in PD models, or similarly, how are we building a term structure in the IRB set of models, right? So let's to quickly dive in the substandard data quality. This is like you are reading a book without having missing pages, right? That if principally if you don't know the missing pages, you are missing out a plot on that, right? So second part is the incomplete model documentation. Again, an analogy which I like to draw in is if you're buying a second-hand car, you'd like to have a car maintenance history, practically, which captures what were the key parts which were replaced or being serviced, right? Likewise, in model risk management, this remains a key aspect which has been highlighted by Biswajit sir, Dheeraj sir, and Amol sir, that model documentation really is the essence, because that is something which gets passed back to the another set of stakeholders, which is second line of defense being model validation unit. The third part is inadequate monitoring of models. Yes, this is there in bits and pieces, but I would like to say it that once you have not defined like a stop loss or order or a threshold limit, right? Maybe accuracy ratios, maybe PSI, CSR, any other parts of it, and you're continuously monitoring over it, the time to actually recalibrate those models, bringing back, there is a sufficient lead time which actually it takes, right? So this is, again, some inadequate monitoring, which we have seen in global banks doing it. The other part is, which has been already been talked about, I believe Amol already stressed upon, is inconsistent application of MRM. There are definitely MRM in bits and pieces across different departments being done, but whether there is a centralized function to it, who's defining the ownership, controls and matrices. So that is one part which was there in that. And the lastly, which I would like to answer upon, is the integrating model risk with enterprise-wide risk. Because if we are practically saying that there's an increase in probability of default, what's its consequential impact to my cash flows and my other set of models? So these are kind of, I mean, the variables which you're using in one models are getting influenced in another models, right? So how are these interconnected between the same, right? So it ultimately leads out a nested risk, which is, let's say in one of the regulations, it's being called out as model families, right? That what are the variables which are being used in one vis-a-vis another. I like Sudhanshu to take over.
Thank you. So in the first slide, we mentioned about how the global regulators have moved from 2011 to where we are currently in 2024. And what this slide we are trying to emphasize is we have been along for the journey. If you look at our presence globally, we are present in almost all important regulatory areas, including, of course, India, wherein we will now see the evolution of model risk management. So be it SR 11.7, which happened in United States, or be it Europe, which has been sort of the paragon of regulatory guidelines for the past few years. We have been there. We have a significant presence across the globe, and that provides a kind of maturity to our solution, which is necessary when we come to India. So this is what view I wanted to present around SAS. SAS has been a leader in this space for the past 10 years. It has been rated highly by research analytics firms. One chart which is pointed out on the screen is of Chartis. I don't think you can see it clearly, but the point that we are trying to emphasize is the scale of our presence and the depth of our knowledge is probably unparalleled because of the kind of exposure we have received from different regulators. So taking from that particular point, I'll pass it on to Pulkit to focus purely on what SAS has to offer in terms of model risk management and how we are planning to take this particular solution to India.
So few points, I'll not take much time here. First is, as Sudhanshu was already explaining, like global expertise, diversity of regulations which tends to come across, right? So that's something which are learnings which gets imbibed as part of product. Second is the comprehensive solution coverage, which measures all across, as Dheeraj sir and Amol was also telling, the model life cycle, which is right from development to the point of retirement. The third part is, I mean, there's a long history and the long community being built for open source, right? A cohesive environment for open source, so that when the model monitoring is done for those set of models which are not really built into the solution, but how the monitoring can be done for those. So that's something which is not only in India, but across the globe. So that is something as a hybrid environment which SAS brings onto the table. To sum it up, I would like to say that what SAS has released or latest, as part of the latest release, is SAS model cards. So model cards can be analyzed to a medical record of an health profile, right? That's how I would tend to put it. For example, if you might see model information, which is nothing but health diagnosis. So model card essentially provides the detail such as its purpose, inputs, assumptions, and limitations, similar to what a medical record details about history, diagnosis, and other parts, right? So that's one part. The second part is a performance matrix. Like, how do we tend to go to for a medical checkup and a doctor says it out, okay, what is your blood pressure, cholesterol levels, heart rate, and so, right? In similar way, what model card actually does is defines the performance measures. I believe there was a question around that also, that what are the different sets of performance measures which are built, depending on the type of problem, whether it is classification, prediction, text analytics, or so and so. So what we have imbibed here is we have imbibed the model validation metrics aligned with BCBS's working paper 14, which provides a comprehensive suite of validation metrics tried and tested across the industry, not in India, but across the globe, right? Something which can be benchmarked, something which can be looked at while ever a regulator, a stat auditor is trying to audit or supervise it, right? The last part, which is more related to model monitoring, right? Just, I would say, just as our health records, right, gets updated based upon the different tests that we undergo, right? The yearly test, which generally are most of the companies do provide in, right? That we undergo these medical tests. It's a similar analogy that how a model monitoring imbibes those things and updates those records. So because principally whether a model is effective or whether our body is effective, our blood pressure has risen, cholesterol levels are in line, these are similar things practically. So if you are able to see a view, 360-degree view of your model in a short, in a concise manner, is what the critical requirement, and I believe this was one of the questions also which was asked, that how do you communicate this to different stakeholders, right? The important part is communication. Statistically might be fine, but it highlights whether it passes, fails, or if it fails, then what are the various fitness statistics which it fails through, right? So in a nutshell, it summarizes the entire model life cycle, the variables used, the performance measures used, and finally, the test and procedures undergone by first line of defense, reviewed by second line of defense, and finally by third line of defense. So this maintains the audit trails of who all have done it, capturing all the logs, finally, and giving the latest report back to the board. They might have it in a concise view. They might want to look at the major models which are impacting the materiality, right? So last, I would like to say the key takeaways from this part is solution definitely is benchmarked with the global regulations. It's, as Sudhanshu covered that, it's trusted by over 75 financial institutions, because we are not saying that, yes, MRM is new, but MRM is not really new to us, because since we have done it at multiple places, we know at least a bit of processes, a bit aware of what the institutions have faced, right? So that's kind of built into the solution to reduce the implementation timelines, because that's an out-of-box rich content. And lastly, since we have done so much of implementations, it's being used, consumed by the regulators across the globe, which marks that it has been a category winner for the past decade in one of the knowledge analyst quadrant, that, because of the length and breadth of offerings which are being given up across by the solution, it brings onto the table, right? So that's it, what we had to present as part of MRM. And if there are any questions, we'll be happy to answer backstage. Thank you.